Hey everyone, and welcome. Today, we're going to break down a super simple but incredibly powerful strategy to start building real wealth. We're going to see how a small, regular saving habit can grow into something truly life-changing. So let's dive right in. So, let's start with the big question, right? Can you really build serious wealth without having a huge pile of cash to start with? The answer, you'll be happy to hear, is a huge yes. And it all begins with a really straightforward plan. And the magic number for this whole strategy? Just 5,000 rupees a month. Now, for a lot of us, that's a doable amount, but what it can become over time, well, that's anything but small. And here's the secret ingredient: time. We're looking at this over a 20-year journey. Look, this is not a get-rich-quick thing. It's a get-wealthy slowly and smartly plan, and consistency, that's your absolute superpower here. Okay, so what's the payoff? You invest 5,000 rupees a month for 20 years. What happens? Well, assuming a pretty standard 12% average annual return, you could be looking at a portfolio worth around 50 lakh rupees. And get this, your total investment is only 12 lakh. The other 38 lakh, that's just your money making money. So how on earth does that happen? What is this wealth-building machine that's driving all that growth? Well, it really comes down to two key ideas working together perfectly: mutual funds and systematic investment plans, or as you probably know them, SIPs.
First up, let's talk about mutual funds. The easiest way to think about it is like you're teaming up with thousands of other investors. You all put your money into one big pot, and then a professional fund manager takes that pot and invests it for you across a whole bunch of different stocks or bonds. You get professional management and a diverse portfolio instantly, stuff that's really hard to do on your own.
And this image here really paints the perfect picture. You see all the individual investors, like you, contributing to this one big pool of money. That cash is then managed by the pros and spread out across tons of different investments to get the best possible returns while managing the risk. It's teamwork, pure and simple. Okay, so how do you actually do this consistently? That's where the SIP comes into play. It's basically just an instruction you set up to automatically invest a fixed amount, like our 5,000 rupees, every single month. It takes the emotion out of it and puts your savings and your discipline on autopilot. Now, this is where things get really, really clever. A SIP isn't just about being disciplined. It has this incredible built-in advantage that actually makes the market's ups and downs work for you. It's a concept called rupee cost averaging. The logic behind it is so simple, but it's so powerful. Because you're always investing the same fixed amount, that $5,000, it means your money automatically buys more units of the mutual fund when the price is low and fewer units when the price is high. You're naturally buying low without even thinking about it. And that's officially known as rupee cost averaging. What it does is completely remove the stress of trying to time the market. You stop worrying about, is today a good day to invest? And you just stick to the plan. You let the power of averaging do its thing over the long run. This table makes it all crystal clear. Just look at March. The price dipped to 6 rupees, so your 1,000 rupee investment bought a whopping 167 units. Now, compare that to January, when the price was 10 and you only got 100 units. After 5 months, you've invested 5,000 rupees, but your average cost per unit is just 8.24 rupees, which is lower than the average price over that time. That right there is the magic of averaging at work. Okay, so we've got the how down pat. We're using a SIP in a mutual fund, but the next big question is, what kind of mutual fund should you be looking at for a big 20-year goal? Let's figure that out. For long-term goals, pretty much all the expert advice is going to point you towards equity mutual funds. So why equities? Simple. Historically, stocks have delivered the best returns over long stretches of time. They do a great job of beating inflation, which means your money is actually growing in real value. So the game plan here is to just stick to a few simple rules. Don't put all your eggs in one basket. Start with 2 or 3 different well-diversified funds. Get into the habit of paying yourself first. Your formula should be income minus savings equals what you have left to spend. And above all, just be consistent. Ignore daily news, ignore the market noise. Your one and only job is to stay invested. All right, we know what to invest in and how to do it. Let's quickly touch on the last piece of the puzzle: taxes. I know it sounds boring or complicated, but for our strategy, I promise it's super straightforward. Here's all you really need to know for equity funds. If you sell your investment in under a year, that's short term, and you'll get taxed at 20% on your profit. But, and this is the important part, if you hold it for more than a year, which is our entire plan, it becomes long term. And long-term gains get a much friendlier tax rate of 12.5%, and that's only on profits over 1.25 lakh in a year.
So, what's the bottom line here? It's really simple. The tax rules are basically set up to reward you for doing exactly what we're talking about, investing for the long term. Just by holding on to your investments, you automatically qualify for a better tax rate. Easy.
We have covered a lot of ground. We've talked about the what, the how, and the why. We've seen the incredible potential. We understand the mechanics. So now there's really only one thing left to do, right? It's time to actually put all this knowledge into action. And here it is, your 4-step launch sequence. Step 1, know why you're saving. What's the goal? Step 2, pick a monthly SIP amount you know you can stick with, no matter what. Step 3, do a little bit of research and pick out a couple of good, solid, diversified funds. And finally, step 4, set up that automatic SIP and then just commit to staying the course. Remember, that incredible journey from 5,000 rupees a month to 50 lakhs isn't built on some complex financial wizardry or trying to outsmart the market. It's built on discipline, it's built on patience, and it's built on the simple, powerful act of just getting started. Your 20-year journey can literally start today. So the only question left is, what's your first step going to be?